This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Russia will significantly increase oil loadings in September, bringing to an end steep export cuts in June-August. As peak refinery maintenance will free up more crude for sales outside the country, three industry sources said, and Reuters calculations based on refining data showed. Russian refineries are expected to cut runs by some 195,000 barrels per day, BPD, or 0.8 million tons in September from August amid seasonal maintenance, meaning that volume can be diverted to export markets, Reuters calculations showed. It's quite difficult to postpone planned maintenance as it is critical for refineries to operate, said one of the sources, adding that exports are likely to increase.
U.S. crude oil, gasoline and distillate inventories fell last week, as net imports dropped, the Energy Information Administration said on Wednesday. Crude inventories fell by 600,000 barrels in the week to July 21 to 456.8 million barrels, the EIA said, much less than analysts' expectations in a Reuters poll for a 2.3 million barrel drop. Crude stocks at the Cushing, Oklahoma, delivery hub fell by 2.6 million barrels last week, the EIA said. Net U.S. crude imports fell by 1.58 million barrels per day, the EIA said.
Moving on to the top news in the energy sector.
Germany will have to import up to 70% of its hydrogen demand in the future as Europe's largest economy aims to become climate neutral by 2045, an updated government strategy published on Wednesday showed. The German cabinet approved a new hydrogen strategy, setting guidelines for hydrogen production, transport infrastructure and market plans. Germany is seeking to expand reliance on hydrogen as a future energy source to cut greenhouse emissions for highly polluting industrial sectors that cannot be electrified, such as steel and chemicals, and cut dependency on imported fossil fuel.
For Mexican industrial park owners like Sergio Bermudez, business is booming amid a wave of U.S. businesses setting up over the border. So-called nearshoring has pulled over $9 billion into Mexico since last October by manufacturers like Unilever, Barbie maker Mattel, and Tesla, lured by its proximity to the giant U.S. market, cheap labor, and geopolitical stability. Yet Bermudez and many of his 400-strong cohort have a serious cost issue on their hands: energy. Industrial parks are under pressure to spend millions of dollars to build federal power transmission lines and substations amid government underinvestment, growing energy demand, and aging infrastructure which is at capacity.
Next, we have the top news in metal markets.
Steel demand in the European Union is expected to slide 3% this year amid persistently high energy prices and sluggish demand, the European Steel Association, Eurofa, said on Wednesday, downgrading its outlook. In May, the industry group said steel consumption was due to decline by 1% in 2023, but lingering uncertainty meant that the prospects for this year have deteriorated, a statement said. The European steel industry has been navigating through numerous challenges for a long time now, from the pandemic to the energy crisis and other ongoing disruptive factors, said Eurofa Director General Axel Eggert.
Copper prices rose on Thursday as a softer dollar made metals traded in the U.S. currency cheaper for buyers using other currencies. 3-month copper on the London Metal Exchange was up 0.7% at $8,679.50 per metric ton by 0315 GMT, while the most traded September copper contract on the Shanghai Futures Exchange advanced 0.3% to 69,370 yuan, $9,727.95 per metric ton. The dollar slipped as traders believed the U.S. Federal Reserve has delivered what some expected to be its last rate hike for the year. We will now look at the top news in the agricultural sector. Malaysian palm oil futures dipped for a third straight session on Thursday, dragged down by a firmer ringgit and cheaper Indonesia origin cargoes, although losses were capped by stronger rival edible oils and crude oil. The benchmark palm oil contract for October delivery on the Bursa Malaysia Derivatives Exchange fell 7 ringgit, or 0.17%, to 4,055 ringgit, $896.13, by the midday break. Packer demand was anemic on competing offers from Indonesia, which were $30 to $40 lower than Malaysia origin cargoes, said Paramalingam Supramaniam, director at Selangor-based brokerage Pelindung Bestari.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.